So, welcome back, everybody. We are now ready to end this rather intense 1.5 days with a panel that sees several distinguished speakers. Emmanuel Faber is with us remote. I think, yeah, we can see him on the screen. Hello, Emmanuel. Emmanuel Faber is chair of the International Sustainability Standards Board, so he really needs no further introduction. To my left, I have Elena Flor from Intesa San Paolo. For those of you who don't know it, Intesa is a very large Italian bank with an international outreach. And Elena is head of ESG steering at Intesa San Paolo. To my right, I have Pierre Georges from Standard & Poor Global. Standard & Poor, sorry, Global. We have been talking about rating for quite some time over these sessions, so I am sure he will have something to say about the topic of this conference. He's a global head of ESG in credit, corporate and infrastructure ratings. And then last but not least, Fabio Natalucci, who's among the co-organizers of this conference. He's at the International Monetary Fund, and he's Deputy Director of the Monetary and Capital Markets Department of the fund. So we have almost two hours, I think, allotted for rounds among our speakers, and we will reserve a part for our Q&As from the audience. So we have organized ourselves with the Q&As. Basically, I'm going to do the Q, and they are going to do the A's, and we will get started with Emmanuel. Emmanuel, I would like to broach to you the topic of ESG fatigue. There has been a lot of momentum building behind this topic, even beyond the inner circle of people like those who have been attending and presenting at this conference, the researchers, people who are into the mechanics of understanding the detail of things. So there has been, a lot of press on this phenomenon, and at present, the impression, if one reads the press, if one reads what the governments all over the world do, if one reads news about large players moving a step back from the G-funds, for instance, one gets the impression that there is this ESG fatigue phenomenon. In the US, in particular, the issue has become highly politicized. At the same time, there is evidence that the industry continues to seek genuine ways to incorporate sustainability in their process, investment, credit, etc. And we have seen that some of the evidence is consistent with this effort. So, from your own vantage point, you have been an important player in trying to put things right in this environment. How do you see this broad ESG landscape?
Thank you, Paolo. Can you all hear me well?
Okay. Yes, perfectly. Go ahead.
Okay, thanks for having me, and sorry I couldn't join you for this meeting in such a wonderful place as Venice. But really happy that we can engage on the topic, which of course is at the very core of what I'm spending most of my professional time and even more now for a bit more than 2 years. I think we can look at it both ways, Paolo, about the fatigue. I'd say there are probably 3 factors of fatigue, and when I hear this or circumstances in which I would hear this word. The first is obviously the fact that so far the alphabet soup of voluntary ratings, even the good ones, S&P and others, and CDP, to just cite a few, have not been able to really move the needle in terms of market price allocation and capital allocation. I'm sure they could if they were more strategically used. I know that because in 2017 already, just using our AAA rating on CDP for climate, water, and deforestation, we've been able to raise money from banks, a pool of 12 banks for 3 billion euros when I was at Danone. So 3 billion is not 3 trillions, but that's a number where we had a significant ratchet on the interest margin if we were able to maintain the CDP rating that we had. So I know it can work. But yeah, the fact that there have been so many, like 500, 600 ESG colors, rating, scores, letters, figures, stars, whatever, doesn't really move the needle. And that I think that is the first element of the fatigue. The second is that in addition to that, whereas probably before there was a sort of unspoken and sometimes very spoken consensus for climate and other ESG aspects around the world, and certainly I'd say a nil obstat, a non-objection for the capital market and organizations to operate in that space. More recently, it's been challenged in many ways, and you've cited some jurisdictions where it's now heavily politicized. And so not only it's not working very well from a mechanic standpoint, but the second fatigue is that you also have to try to convince people that you would expect to allow you to do what you have to do. And in jurisdictions where litigation is very present, it's not only its fatigue, but it's potentially a risk as well. And we see very concrete momentum in some parts of the world around this. And I think the third is that establishing a framework that would be decision useful means a new language and potentially, unfortunately, a number of new languages, which creates another fatigue from the voluntary ESG fatigue to the regulatory ESG fatigue. That's the trend that we can see is very, very concerning for corporates, for banks, and for the system overall. But we have also to recognize that any new language will take an investment. And when you train, you need to manage your own ability to train at the right at the right pace and with the right tools and the right support, with the right coaching. And this is where the fatigue is as well. So that's, I'd say, where I see fatigue. What I can see as well is an incredible momentum, because you were, Paolo, mentioning corporates and business, finance, but also jurisdictions. As you probably all know, or most of you know, in this room, we started our work in 2022, a year after we issued our general requirements, IFRS S1, which is a quasi-accounting language. So it's not an ESG, new metrics, new color, whatever. It's an accounting language, pure point. We can discuss as much as you want about this. It's accounting. It's about putting climate, ESG, social, nature, whatever risks and opportunities, including major impacts or significant impacts of corporates that can affect their prospects or their cost of capital because of investor preferences and whatever that is going to be connected to the financial statements. It's even a requirement in IFRS S1. And at the same time, we release a thematic climate standard, which basically in substance is equivalent to the European standard. We worked a lot on interoperability and alignment on climate with them. It's significantly simpler because we are not operating the other side of different materialities and compliance and conformity and policy objectives that the EU have, of course, as a sovereign jurisdiction. So that was not a year ago. Then IOSCO endorsed our standards. The Financial Stability Board has retired the TCFD framework into our climate work and IFRS S1 and S2. And we are now 10 months after, and at IOSCO's general meeting in Athens, we took a first global stock take of the cohort of countries that have started their journey toward the adoption of our language, more than 20 around the world. And they account for more than 50% of global GDP and more than 50% of global greenhouse gas emissions. That includes China. That includes Global South, Nigeria, Costa Rica, Bolivia, Bangladesh, but that includes literally the whole of Asia, from Japan to Australia, including Taiwan, Hong Kong, Korea, Singapore, China, as I mentioned, etc. So the momentum is really super impressive. And as I guess most of you know as well, the FSB and now the Basel Committee has decided to use our standards for supervision on the Pillar 3 work about climate, and the international public sector standards has also elected our standards for their sustainability work. So the flip side of that fatigue is that there is an absolute need to create a decision useful, cost-effective language, and this is what we've been tasked with for 2 years. And I think where we are, and given the proportionality, the scalability, the pragmatism of what we have designed, apparently there is more momentum. And I hope that the enthusiasm for the need for this tool will overcome the fatigue aspect that you mentioned, which I think is also related to a topic that I'm sure we will discuss later, which is the mounting physical risks and uncertainties on a number of ESG topics, starting with climate, of course, and nature and water and others, beyond the transition risk that, of course, is always at stake given the political consensus evolutions. I'll stop here, but this is for just introducing this panel conversation. Thank you.
Thank you very much, Emmanuel, for those words of hope. I think that we all believe that you're right, and I think that the work of the ISSB has been instrumental in order to carry on and to carry forward this agenda, and I do concur with you that there are reasons to be hopeful and to keep on pressing on this front. I remember reading somewhere that on financial accounts it took decades to get to the standards that we are accustomed to having now. The challenge here is to try and do the same with sustainability standards in years rather than decades. But I think the momentum is there. We need to keep on that momentum. Let me turn now to people who are more directly involved in the market, and I would turn first to Elena on a question on the state of the art from the viewpoint of a large commercial bank on the topic of this conference, that is embedding ESG factor into the credit progress. We have seen over the last day and a half that there is progress, there is small effects, but and uncertainty around those effects, but clearly a lot of asterisk around coefficients. How do you see this progress? Do you see differences across jurisdictions that, for instance, your bank is involved in? Differences across industries and financial industries, maybe?
I would start by saying that we were, let's say, in a sense, pushed in this direction by but some of the documents that were published by the authorities, and so the regulation gave us a great push in this perspective, and particularly from the ECB and the guide for the management of environmental climate risk with the 13 expectations. And so looking at what you were asking about jurisdictions and so forth, of course, this is a EU-based regulation, and probably the push, we've seen this push more on EU banks and generally from regulation on EU banks rather than on other geographies. And with these guide, let's say that it was for us also the occasion to start with a big project, transforming project for the way we do our credit process, and to revise the overall credit framework to include ESG and particularly climate consideration. But more generally, the project was on ESG. And we, as you know, of course, due to the timing also of the ECB, we had these gap assessment done in the early 2021. The action plan in May 2021 approved by the board of directors with a number of deadlines then after that, going to the end of 2023. So clearly addressing that, in particular, one expectation number 8 was pointing at credit. And so the overall idea objective of the project was really to integrate that. How we have been doing that. Of course, there is not one fits for all, let's say, approach. I've seen that different banks have chosen different approaches. Smaller banks, of course, have had different timing, 2 years after big banks. This is also due to the fact that huge investments are needed, investments in terms of IT, because to review the overall credit process, of course, needs is linked to the need to integrate all the ESG data points and information within your systems, which is a big effort in terms of investments and also in terms of training. You need to train the people in order to have these effects, and you also need to calibrate the overall model. So there has been let's say a big effort in this respect. And what was our perspective? We wanted to be as granular as possible. We've seen other intermediaries looking more at policies. So you've got sector policies covering all the sectors, so general criteria. In this sector, I would follow these criteria. We wanted to be more granular. So we've been looking at these, let's say, sort of revolution within the credit framework on three levels. The first one is looking at the sector. So we have been, let's say, matching the sectors with the ESG riskiness, looking at the 3 dimensions of the ESG and with a particular focus on climate, and looking also at the opportunities linked to those sectors. And these allowed us to have, let's say, a sort of breakdown of sectors into different buckets that are linked to credit strategies, from disengagement to positive engagement with these sectors. And that is the first level. Second level would be the counterparty. So we developed internally an ESG score using over 100 KPIs and covering some over 230,000 counterparts, accounting for 170 billion right now. So we are expanding the model. Now we started from the parent bank, then looking at more, let's say, the subsidiaries, looking at specific kind of business like project finance and so forth. So the idea was really to have the same model, not only for big corporates, because if you're looking at ESG ratings, you usually have ratings for listed companies, but you do not go down the portfolio. So you are only able to cover a small part of your portfolio. So we want really to go deeply into our portfolio to cover also the SME, which are a very important part for us. Of course, the ESG scoring had the problem of data availability from our customers. So we got raw data from info providers, and more we have, of course, to rely on them, but more and more we are trying to collect data internally in order to be more consistent with what is actually the performance of the counterparty. And the third level is transaction. So what is the transaction that you are financing? And we developed internally, following also the EBA guidelines on the loan origination monitoring regulation, we developed internal rules to classify what we consider as sustainable and what is not sustainable. And of course, when we introduced the rules, we had a number of frameworks, but taxonomy was still to come. Net zero effort was still to come. So for sure, we will need to revise these rules. So how does it work? It works in a very granular way, and it means that let's say when you're looking at a counterparty, you're really looking what is the sector, what is the ESG score, what is the transaction user proceeds that you are financing. So trying to be very granular, because what we have seen also during these days, of course, these models that are counting for large portfolios, but then you have, let's say, this granting process that is on a case-by-case basis, and we want to be very specific. What are we financing? Who are we financing? What sectors? So we had to work on that. It took us a couple of years. So it was a huge effort. Also having effects on pricing, on credit risk appetite, on credit strategies. So really integrated within the overall process. And now the effort is now on calibrating the different, let's say, measures that we can have in terms of pricing, for example, notch up, notch down, and also on the quality of the data that we have for the sectors, but mostly on counterparts.
Thanks a lot, Elena. If I may ask you in a flash, we saw again lots of stars around those coefficients and you know, few basis points effects. If you were to react in a flash, does that square with your experience?
Well, the basis points that I have seen mentioned are very, very limited. So usually we have more, but it's particularly because when we introduced that, the interest rates were very low, and so even a small difference really made a difference. Of course, with a higher interest rate environment, that changes a bit the picture. But at that time, when we introduced that, it is true that we do not have that big discount, but it is in general a sort of an incentive. And what we have seen, for example, we have launched this circular plafond within the business plan. We announced 8 billion available for this plafond. We are over 9 billion in the first 2 years, and this is due to the fact that we apply incentives to that. So they still work, even if the measure of the incentive is not that high, as you would probably think.
Thanks a lot. Yeah, I think that the issue of the level of interest rates in the period that we have gone through, and that is basically used by most of the empirical papers that are around, and that we have also seen in this conference, are to be taken into account. Is an issue to be taken into account when looking at this evidence. Let me turn to Pierre with more or less the same question about the topic of this conference. What do you see as progress? We have had rating agencies all over the place, commercial bank ratings via internal models, etc. And one lingering question there is to what extent are those ratings incorporating ESG factors? And from private conversation with colleagues of yours, the answer I get is we're working on it, like everybody else, more or less. So just broadly speaking, your perspective on the topic of the conference.
Yeah, thank you. I think, yeah, we are working on it. May not be the answer I would have given to start with. I think, yeah, we definitely are incorporating this. I think it's just that those are evolving risk, and I'll get back to that notion of evolving risk. That's very important in our mindset these days. But maybe just going back to what has been discussed over the past 2 days, and to come back as well to Emmanuel's comment on ESG fatigue. I think we are at a point where, and this is proven by all the research which have been presented, and I was really impressed by everything that was presented by the different panelists, that we're in a time where we have gone into a lot of investments into ESG, into climate in particular, but ESG more broadly speaking. Investments in time, investment in human resources, investment in integrating everything into our IT systems, into workflows, and of course it's a lot of money. And the reality is that the reward is not there. The reward is not there because we come up with, as Emmanuel was saying, somehow there is little difference that is being put into credit risk, into capital allocation sometime as well. It's not that evident, and that's the reality. I mean, I think we're all stricken by the presentation from Miguel and the 5 basis points, and that's all to some extent. That's all. It may be a lot of money, but it's not disruptive, and at the same time, every institutions are putting quite a lot of effort into that. So, does it mean that it's worthless? Not at all. That's not our feeling. To the contrary, we feel that it's we need to be prepared. We need to be prepared because of that notion of evolving risk, because things could move. And because if we have that right understanding, if we have the right tools in place, we may be faster in reacting. So that I just wanted to say that before going into the question of that was really put on the table here, and go to the ESG now. I mean, ESG to us it's a mixed bag. It has a broad definition. It's a broad topic. There is some correlation between E, S, and G, but ultimately they also it's not always evident to find that correlation. So we need to make that separation, and this is what we've done on our side. It's really to separate what's E, what S, what's G, and within those 3 dimensions, going into the details, just like Elena was mentioning. I mean, you need to go down and drill down to the issuer level, each entity, and see what it means for each of them and what they are really exposed. So that's one thing. So that means as well that, again, that was part of the discussion yesterday, that ESG scores may not be a good tool to look at credit risk at all. Actually, that's really our feeling. So we would not incorporate anything that is a form of ESG score because they are measuring something else, which is very important as well. It's a notion of impact on society, impact on the planet, but it's not credit risk. What's important is rather the data that is behind these ESG scores, and this is what we're using. So what will be the exposure to a given company to, I mean, transition risk through greenhouse gas emissions, for example, pollution, or to physical risk? That is useful information. But the score itself is just measuring something else. So we really need to get away from finding any form of correlation between the ESG score and the credit risk. So that's one message I wanted to give. The other one is we need to think about the materiality and the transmission channels. And those are the 2 very important dimensions on which we need to work. So the materiality will be very different by sector, by geography, by entity. It relates to everything that Elena mentioned. It could be regulation, it could be technology, it could be just the gross exposure. And the transmission channels, that's where we need to put all our efforts on. I mean, because the transmission channels is how we will understand when, if and when those risks will materialize on credit. And that's what we've been doing at S&P. Sorry, I do a bit of back and forth, but going back to G, because there was something yesterday which also struck me, saying, well, it's all about ENS, G, it's not so much of a risk. Well, actually, we believe the contrary. G is the biggest risk, so that should not be forgotten. So we can separate that from all the research we're doing, because maybe it's something we know and we manage much better because it has been there forever. But in our findings, I mean, not in our findings actually, in reality, when we look at the rating stats, the governance factors are the biggest reason for rating movement. So the G part remains a key topic for us, a key area of focus. And that's mostly about risk control, risk appetite, management competencies. Those things, I mean, are really core to understand credit risk. The S side, we have put some effort into that, trying to understand how we could look at social risk and relate that to credit. And frankly, it's far from evident. We have only, I mean, let's put aside health and safety and how you define that. But all the other topics, I mean, are very difficult to, I mean, to blend or to analyze in a proper way, with some exceptions. But I'll give you a simple example of forced labor or bad working conditions in Asian countries. Frankly, it hasn't moved anything into some ratings like fast fashion, like credit risk. I mean, not talk ratings, but more broadly credit risk, tech companies. And we know that those issues exist. I mean, it's well documented, but it's not where, I mean, the regulation or the consumers are really taking a lot of care. So they are not changing their behaviors. That's unfortunate. We can blame many people for that, but that's the reality. And if we were to say, okay, that's the credit risk and incorporate that, actually our ratings performance would be wrong. So that's another reality, which is, again, unfortunate, but real. So we are back to E now, and all the efforts that are on the E risk, and most of the presentations were on climate yesterday anyway, so let's focus on climate. So on climate transition, we had deep dive on the hard to abate sectors, so mostly on the corporate side, corporate and infrastructure. And frankly, we did a lot of work on that, trying to understand how things will move, notably in Europe, because this is where the regulation may be the most stringent. And the findings is that, well, actually, almost, I mean, with a few exceptions, none of our ratings will move over the next 5 years with what we know today due to decarbonization and transition risk. And this is because the trajectory on which they are is actually manageable within the credit rating. They can adapt, I mean, those corporates can adapt most of the time. So again, thinking about the low-hanging fruits of all the efforts we've been doing, actually that's not proven to be moving so much the credit risk. Post 2030, we see a lot of risk happening, but those risks come with a lot of uncertainties as well. Uncertainties about the scalability of technologies, on whether there will be stricter rules, stricter regulations, and frankly, we don't know. I mean, we know what the political landscape is today. It's moving, but is it moving as fast as one could envisage 2 years ago? Not so sure. And hence, it's very difficult to incorporate that into the ratings today. So that we're in that position where, again, the investments that we've done, the heavy investments that we've done, are not showing a material difference. So that's on transition, and I will finish on physical risk. And I know I'm being quite long in answering these questions, but I hope it also gives that landscape. On physical risk, we lag behind. I mean, it's not rating agencies. I think it's collectively at very large. What we find is that entities do not manage to measure their exposure to physical risk and what it will mean in terms of financial implication. There are more and more tools, more and more information available about understanding the gross exposure, but when it comes to the net exposure, are these entities ready to cope with the physical risk? That's less clear, meaning that all of the other actors on the marketplace don't know either. I mean, the insurance companies, we talked about that yesterday, the banks, us. So that's maybe an area where we will learn much more, where disclosure will help with everything that is being put in place. But frankly, I think this is a little bit early. This is an area of risk where, frankly, things could be moving. And I stop here because I talked a lot already.
Thanks a lot. Let me pick up a few items that you mentioned first. Let's do away with the ESG catch-all score. I think this is an important message, especially for a research audience such as this one, probably going beyond the scores, the catch-all scores, which are simple, easy to use, but also possibly deceptive, is a must at this stage. More transparency by credit rating agencies or methodologies is going to be welcome on this front too. The other point is the political uncertainty, which brings us back to the remarks by Emmanuel. That is the fatigue issue that we started with. It is indeed a problem, I think, and may lead in the slant you gave to the topic a room to be less optimistic. Let me stop here and move next to Fabio with a completely different type of approach and issue. We have been talking even in this conference about mainly climate and mainly about mitigation. This whole discussion about emission is largely about mitigation. But the fund points out that about 90% of climate-related financing flows are about mitigation as opposed to adaptation. Adaptation is receiving less attention and, more importantly, less money. But adaptation needs are very relevant in very many countries, especially in emerging markets. So to Fabio, I would ask a view on the challenges related to climate adaptation finance. What role can the private sector play given the public good features of many adaptation projects which do not readily lend themselves to financing by the private sector?
Well, first of all, thank you for having me here. It's always a pleasure to be back in Venice. So let me try to link the question to what we have discussed this day and get to the end to this maybe. So you asked at the beginning to Emmanuel and the private sector representative here about the ESG. So let me start with numbers. I think it's helpful to put numbers there, and then from there I trickle down to adaptation. So think about the estimates of needs, right? So there's a lot of numbers out there. We have used the International Energy Agency numbers. So the numbers are that the needs globally for transition all the way to 2030, it's about 5 trillion a year, trillion with a T. That's why I was asking that question about the basis points. About 2 trillion of those are in emerging markets. The numbers that you see in terms of flows to emerging markets, it's a fraction of that. Like a really small fraction of those numbers. If you put that in terms of investment needs, for example, how much you need to move from climate investment as a share of investment, it will be 4 times the size to get to those numbers. The flows will be multiples of what we see. Now, with that, and that's just transition, right? Mitigation is another in the hundreds, so like smaller than hundreds and hundreds of billion a year. till 2030. Let me put a number of what global sustainability issuance is. And global sustainability is a much broader concept. It includes stuff that's nothing to do with climate. So, for example, that issuance rose during COVID, but because countries were issuing essentially sustainable bonds, those were issued related to COVID and the pandemic, right? So think of climate as a small fraction of this. The Q4 number last year, sorry, the Q1 number for 2024, it's about $400 billion total globally. Remember those 5 trillion plus the 100 billions. That's actually, it's a good number because it's up sequentially from the previous quarter, is up 30% compared to 2023. And in fact, it's the highest number since 2022. So I think there's good news there, but it's still a very small number. Half of that, about 50%, is accounted by green bonds, which is more relevant for climate issues here. Now, it's mostly issued by governments. So the share of financials that has been issued is actually declined, right? So if you think about what financial institution may be doing to fund their activities. So it's mostly government and other forms of issuance that people were paying attention to, like sustainability-linked bonds, for example, where you have a specific objective in mind. That share is actually going down quite a bit, including green loans going down. So it's really green bonds issued by sovereigns for the most part. And the largest, I don't want to call it jurisdiction because it's more than one, but the largest geographical area that issue this is Europe. If anything, in Asia, the number is going down, primarily because China is going down, but it's actually getting smaller. If you think about how much of this going to emerging markets, actually Q1 2024 for EM was a bad quarter. It was down 30%. So even less as a share going to EMs. So those numbers will not take us to these trillions that is needed in the next, at this point, 6 years. We're not talking about 2050 anymore. Now, adaptation, it's a much smaller subset of that. It's not trillions, but it's still in the hundreds and hundreds of billions a year. Think about the flows that goes to adaptation in terms of as a share of global flows. It's between 5 and 10%. There's different estimates out there. Of that, about 5% is private sector money. So it's a small number, and it's mostly public money. And to get to the numbers that people are estimating, you need to scale up by more than 10 times where we are today. So you need more of those flows, and it's the private sector is playing a significantly small share in emerging markets. Now, why the question on adaptation? So we have a relatively new facility at the IMF now called Resilience Sustainability Trust that was approved in 2022. The idea is for low-income countries or low-income emerging markets, if you want the lower tail. I don't remember the exact number, maybe 140 countries can apply to this. This is long-term money that the fund provides for stability of balance of payment as it pertains to pandemic, but it's not really where it is now, but mostly climate resilient, right? So you borrow below market rates, you start repaying after a number of years, and there's a lot of flexibility how to use the money to build climate resilience. Can be for adaptation, can be for transition. Those are low-income countries. So think about that the footprint of this country in emission is minuscule by global standards, right? So when people look at the emission, okay, 2/3 of global emission comes from EMs. So this is one reason why we keep bringing up EMs in this discussion, because even if you fix US and Europe by itself, you still have 2/3 and rising share that are issued by a handful of countries in EMs. But unfortunately, the wind doesn't keep it on top of those countries. That becomes a global issue. So if you don't fix EM, you won't fix this, essentially. So those countries, though, are smaller countries where they have minuscule footprint. So I don't remember the exact number. I think more than 50% so far at this point. A lot of those countries, forget the actual number, but it's about adaptation. So the issue is either droughts in some countries, is lack of water, is rising seawater. Those are not emissions. Those are not why they're asking for money. So that's, I think, one of the drivers why we're starting to do more work on this, because this country it comes with reforms measure conditionality, and when we advise on this reform measure, we really need to understand what is adaptation finance. Now, what are the challenges? I think one is a perception issues. There is somehow this widespread perception that adaptation is about public goods, right? It's about roads, it's about dams, or something that governments do, and private sector has no role there. I don't think it's true, but even there, at least in advanced economies, you can think of some of these private public goods where the private sector can play a role, right? So I'll just give you an example. Where I live in Virginia, there is one major highway now that has been refixed and put together by European companies, actually. So it's not paid by the Commonwealth of Virginia. It's actually been built by this, but the way they get paid, they have essentially a share of revenues for the next decades and decades and decades, right? So you can think of using some of these business models in emerging markets. It's more challenging, obviously, but it's also not just those, right? It's about a lot of sectors. So this includes agriculture, has to do with health, education, water, transportation. So there's a lot of sector where it is about adaptation and where the private sector actually can play a role. The challenge is, one, I think that there is no clear revenue stream. So we need, in some sense, build some similar concept of taxonomy that we have for mitigation. And that's much more challenging because you have a lot of these sectors. And so there are some work that has been done in getting a taxonomy for adaptation, and then identify what the clear revenue streams are. But there are sectors where you can think about, like agriculture is one, for example, right? The private sector clearly can have revenue. So then the challenges are, how do you, if you want to bring private capital, like global, say, institutional investor, I think the challenges become one of portfolio design, right? How do you, they're not going to invest in the $5 million project in Africa. They're not going to invest in the 10 million. They don't, the number too small, it's not diversification there. So how do you build a portfolio to attract global capital? And I think there are, one is, how do you diversify, right? And I don't think there is an answer at this point, but do you diversify, for example, one sector across countries, or do you diversify fewer countries but across sectors? The diversification effect of a portfolio is very different, right? There is an effects issue, for example, depending on the countries you think of, or there is a non-diversifiable element if you start going to different sectors, for example. They're hit by different adaptation needs. Then there is, what is the amount of concessionality that you need? And I think the expectation is, compared to concessionality needed for, I don't know, renewables in emerging markets, the share may be higher. But I think that's a prior. I think it depends on the country, it depends on the sector. That's why having some sort of taxonomy is very important. Then one last point, to the extent that, as I think yesterday in the keynote, the issue that if mitigation start getting late, it will have it will put more burden on adaptation itself, right? Because if you don't mitigate at some point, you need to adapt faster and more. You get into these tipping points. And so there is an issue. I think you can't separate the two. It's not either adaptation or mitigation. And we are past the point where you can treat them separately. I think the feedback, it's obvious, at least in some of the emerging markets, quite obvious. But then also make sure that when you invest in adaptation, for example, you don't invest in adaptation projects that they are good for adaptation. Think about them. Or you use cement, though, that it's very negative for mitigation. So I think trying to think of the combined two in terms of feedback effect, but also in terms of financing projects that at least they're not negative for transition. And those are huge challenges, and I think the thinking is still early on. There are adaptation funds and some of the structures that have been treated very either by sector or very separate by country. I think there's a need to step back and think about taxonomy and more broadly what is the role of the private sector. The only issue is that we don't have 15 years to do that like we had for the transition before. This needs to be done now. It needs to be done fast. And those numbers, they're so small that they're not going to make a difference. It's not just the basis points that is small, it's also these floats that are absolutely minuscule.
Thanks a lot, Fabio, for those sobering remarks. Let's hope that this new trust fund by the EIEF helps do something. The World Bank is also working on scaling up, and there is at least from this viewpoint room for hope. Multilateral development banks may have a role, this. And with these words, I would.
We're always hoping for donors' money coming into the fund. So if I can do a fundraising here, if there's any hope that at least some jurisdiction in country can, European countries, if the fund, the trust is open. So
okay, crowdfunding Natalucci's project. Emmanuel, you wanted to chip in?
Yes, please. Thank you so much. Well, thank you all for your comments. I'd like to maybe just briefly go in again. I was struck by what Pierre said about physical risks not being taken into account, and Fabio about these numbers that, these orders of magnitude that, of course, we all have in mind. What I'd like to say is, I think I'll go back. What we are trying to do with the ISSB standards is to provide every corporation that now will either voluntarily adopt, as some have already, or will have to comply because 20 countries, already half of the global economy, have a target to implement the standards in the next few years, not decades. Their journey, Turkey has said 24, Brazil 26, Japan 25. EU is in a way done with the climate similar that we have with them and many others. So if I follow that track, the global debt plus equity listed markets are about 400 trillions, which if you compare to the 4 or 5 trillions that Fabio were, I think, rightly pointing to for the transition, just imagine that this new language that we are developing is able to move just 1% per annum of that global footprint of listed equities and bonds, and you fund the transition. Of course, adaptation is on top, but I agree as well that it's probably likely to be significantly less than mitigation. But for the first time ever, policymakers would have the ability to leverage the capital markets because information would be brought transparently and materially to investors and bankers in terms of both physical and transition risks and opportunities. And I would like to insist on this point, which is that there is so much that public funds and entities can do, because at the end of the day, the transition will only happen and the adaptation will only happen if the economy, the microeconomics, the corporates are doing that every day. I mean, the heavy lifting, as we all know. And this is not a place where they are only looking at this as a risk for them. With the appropriate language, they will be able to share as well the opportunities, which is critical because, maybe they will not beat climate change, but they can beat their competitors at climate change. We are requesting companies, and now again, in frameworks, regulatory frameworks, probably half of the global economy soon, to release both climate risks and climate opportunities when they're material. And so if, as a food company, you have a better climate resilience plan for agriculture in the future and water stress in all your supply chains than your competitor, you definitely have a better climate resilience, and you definitely will be able to have a competitive advantage also from a capital allocation standpoint and cost of capital, whether that's debt or it is equity. So with that, I would just want to say and conclude by the fact that I agree with most of what, and I think overall what Pierre said. Very little correlation of global ESG with risk assessment. But the first thing is that I think climate is there. The climate risks are way underestimated now. And I think there will be econometrics and others climate scenario coming soon that will show how underestimated they are at global scale in terms of their impact on global GDP and therefore systemic risks. And if this is systemic for the macroeconomy, it is for the microeconomic actors as well. My office is in Frankfurt. The Rhine River for 2 years now in a row has been so low at summertime that the ships had to be stopped. And that created inflation all around Europe because you had to travel with much smaller ships. The Panama Canal is lower than ever, and you have months of waiting ships from China to Europe, or they have to do the whole way down to through South America. And I could go on like this. And so what I would like to say is that looking at physical risks will be the way to go beyond the political consensus, because physical risks don't care for political consensus and for ESG backlash. They are there. And whether you beat your competitor on addressing those risks or not, fighting for the water that will be scarce in some cities. Foxconn had to stop a factory in China for 6 weeks. 100,000 employees stopped to supply Apple because there was a big city of about 2 to 3 million that was going to lack water that summer. That was last summer. So these things, they are coming, they are here. And the last thing I'd say is there is a big correlation that is appearing more and more between carbon and water. And I think if you follow that path, you end up with equipping the corporate sector to make themselves their own assessment of risks. And because they will have to apply our standards, including with their governance, because TCFD is about metrics, risk, strategy, and governance of those issues when they are material, I still believe that we now have a hope that we can actually structurally address not everything, but a good deal by putting the markets to work in valuing the risk and the returns of microeconomic actors addressing those risks. Sorry, I've been a bit long here.
Thanks a lot, Emmanuel, for jumping in concerning physical risk. I think it cannot be more right. Let me remind of the Pakistan episode recently. That is the first one in which you begin to see macroeconomic scale consequences of water going in the wrong places at the wrong time in the wrong quantity. So it is clearly an important issue. So here we have about 1% of global equities and bonds that could solve the problem. So it's within reach. That is Emmanuel's starting point. At the same time, we have the trillions that are the 1%, small in relative terms, but still much larger than what is actually flowing in those projects. So the floor is back to market participants here.
Can I say one thing on these numbers that I think can complement
Go ahead.
The Emmanuel's number, right? So another way to get to this number is to get rid of subsidies to fossil fuel. The fund has done estimates of you're in the trillions even there, right? So if you cut those subsidies there, that money, obviously money is fungible. It can be used to address a lot of this. So you can find different combination of this to get to this number. It's just politically very difficult to get rid of fossil fuels.
When you start touching the subsidies, you touch the S of the acronym, and you rapidly get into trouble, and you go back into politics. So political issues. Sorry.
Can I jump into this again?
You please jump as much as you can.
Yeah, sorry. I lived for 4 years in Asia, and I was in Indonesia every month for 1 week. And there have been heavy subsidies on fuel in Indonesia. There are very serious, and I'm sure you guys know that, very serious, numerous macroeconomic analysis that shows that every cent or dollar of subsidy that goes 80% to the first quintile of revenues in any country. Because in Indonesia, the only people that have enough money to put 2 tanks of gasoline in their car are the people that of the elite that have 2 cars. The guys that are just using their gasoline in the slums, they don't. You need much more redistributive, precise policies in order to address the just transition. Because I heard you, Paolo, say social. I totally agree. There will not be a transition without a social transition. But the subsidies are demonstrated evidence that they favor the 20% of the first quintile of revenues in any country. It's a given. It's a given. It's not easy to get rid of them because this elite controls the politics, of course. But that's the reality. Let's face it. No one has to comment on this, but that's a fact. But it's very true that if you were going to do much more targeted revenue distribution on affordable energy, you can indeed get rid of the subsidies that Fabio has mentioned. I just wanted to be clear on this.
Yeah, but I argue that those very powerful retired people are exactly the ones that have the power to stop things from happening. And I could go at length about subsidies going to the wrong people based on the experience of this country, but let's not enter into this subject. But so all this, I think, poses gives new room for Georges, for Pierre, and for Elena to chip in. Fabio was mentioning this possibility of public-private partnerships as a possible solution for the emerging markets. In this case, the partnership could be between advanced economies operators, financial intermediaries, companies, and developing countries' governments. What is the best way, in your view, for the financial sector, for your institutions to help this transition challenge go through? I will turn first to Pierre.
Thank you. It's a heated debate. That's why to put more flames into that. But indeed, I mean, just thinking about this challenge, I mean, if I can just comment as well on, I mean, the funding gap. I think one big issue we have when you look at the global number when it comes to funding gap, but we have a funding gap in developed market, and we have a funding gap in emerging markets. And of course, the one on the emerging market is much bigger, but there's still a gap on developed markets. So where the money goes actually will naturally flow into developed market first, just to fill that gap. So that's one of the issue as well we need to solve for emerging markets is, yeah, as long as our own problems in developed markets are not solved, be it for, I mean, mitigation, and especially, I mean, we did a study last year on the fact, I mean, was there a funding gap for clean tech? Yeah, there is a funding gap for clean tech. Maybe not so much for renewables, but for other technologies, which will bring us to the challenge of how we address that. Other technologies, maybe batteries, maybe infrastructure, maybe all of those things. Now we put, I mean, that was a year ago that we did that study. Now we have AI. AI, I mean, we see studies now thinking that we need 10-15% more power to accompany the development of AI. So that needs to be financed again. And that's more money that needs to flow into developed markets and not emerging markets. So that's another challenge. So just to stop here, but just to remind that reality that money goes where it's easiest and where you are pretty sure to get your funds back, and that's more developed markets and emerging markets. Now, again, I know I'm putting flames here, so there would be a lot of reaction. But now, how can we make things better as financial sectors? First, maybe going back to the investments that have already been made and continuing on that. So we need to continue to build capacity to recruit experts, because those are domains on which we financial players are not necessarily the best at. I mean, understanding those notion of climate change, physical risk, adaptation. So this is a big part of what we are doing. So this notion of building databases, building expertise, visualization of risk is also very important, because this is very complex and we need to bring it back to something which is digestible. On our side, it's a lot about transparency as well. Transparency, I'll get back to that because that's a key element, but transparency around our criteria, how we work, how we analyze things, which will help to somehow embed that into projects. I mean, if you want to rate some projects, you need to have a clear understanding of how the different stakeholders will react. We need more research. I think that's ongoing, but we need more to have a full understanding of those topics, and data will help. I mean, Emmanuel rightly point to the fact that it's a journey which is going quite fast, and thanks to institutions like ISSB, of course, we'll get more knowledgeable on those topics. So that's quite key. But yeah, now going back to how this ecosystem all work together, to me, yeah, there are three things. One is transparency, the second is coordination, and the third is reality checks. Transparency to me is really about understanding everyone's constraints, angles, innovation. In many panels in which I participate, notably with industrial players, actually thinking about those projects when it comes to hydrogen, carbon capture, not talking about adaptation as a whole, but those people don't talk too much to each other. And they don't talk with financial people either, or they talk separately. And we haven't been able so far to really create an ecosystem or a platform where we can really work on those problems properly all together. I mean, or it may emerge, but frankly, that's not the norm. So that's a pretty big issue. It's also about, I mean, putting everyone in the same place at the right time. One of the issues that we are seeing is that there are a lot of bottlenecks. So people try to progress in one direction, then they engage with another stakeholder, which would come with its own hurdles, and it's too late. I mean, we lost maybe a year and a half, a lot of money, and suddenly there's something that wasn't taken from the beginning. So making sure that everyone works together from the beginning, that's what I mean by coordination, is very, very important. And in that respect, financial institutions can play that role of integrator or connecting hub, because they are talking to the different stakeholders, and they can put everyone in the same room. Last but not least is that notion of reality check. I mentioned one with the financing gap and where the money will naturally go or flow. Another one, which is quite important, is that climate factors cannot overrule other material issues driving the creditworthiness of an entity. Unless we change the rules, but we are not in that space. And the reality is that if you're looking at financing a B- entity, emerging markets, typical type of rating, B-, B-, you cannot expect to become investment grade. I mean, that's just the reality, because you have other drivers which are very important, and you cannot play around with that unless you put other forms of substitutes in place. But you cannot rule out that evidence, despite, I mean, the clear need for the world to build those mitigation or adaptation actions. I mentioned also the choice of technologies, and that's also another big issue. I mean, where the money should come from. If you're thinking about emerging technologies, immature, I mean, is it something that you finance with debt? I'm not so certain. I mean, that has never been the case. You start with a startup will be funded with equity, and once it's a proven model, you go with that. I mean, that's how it has always gone, and that's, I mean, one of the other dimensions. I mean, I'm taking some very simple stories which everyone will know. Amazon, Tesla, they started with a B- rating or B rating maybe, until it was a proven model, and then they went to success story that they know, but and they can really raise debt, being investment grade once the success is there. But let's not reverse. I mean, we are measuring risk. We are not funding ventures within, I mean, or betting on ventures. That's not the role of the, I mean, credit agency or any credit risk analyst. So that's also that notion of making sure we should not expect the debt market or to fund those ventures is also important. I mean, that's the reality that, again, let's not bet on things that could not happen. And last but not least is something that was also presented, I mean, is the reality of where the money is going. And we just talked about the subsidies of oil. And we'll talk about the funding of, I mean, the banks, where the lending book of the banks, which are still very much into those brown sectors, even if we can see some movements here and there. I mean, the reality is that it's much more towards the brown sectors compared to the green one still. And unless we also change the rules there, it's going to be difficult to accelerate massively the allocation of flows towards those mitigation and adaptation topics.
Thanks a lot, Pierre. We would turn to Elena for her perspective on this issue.
Well, on this issue, I would like to start from what you were saying about public and private, in the sense that, of course, we can have, let's say, targets, but we need to be, let's say, these transition effort needs to be backed by a sort of industrial policy that is in line with these objectives. And in the sense, we are still lacking some of these subsidies have been mentioned, and sometimes they are not used properly. But in general, we need, let's say, a policy that is going that direction, because we were also mentioning the few basis points. We can move something, but it needs to be, let's say, a sort of effort in coherence with the public effort. So while I've seen in some cases, starting from the action plan of European Commission, really a clear focus on banks to reorient banks or financial intermediate to reorient financial flows. This is, of course, important, but it needs to be accompanied by a general effort. In our case, done at European level, then at country level, because, of course, every country has its own characteristics and strengths and different starting points. And we see that particularly as our portfolio is also highly concentrated on Italy. When we are looking at sectors, we joined the Net Zero Banking Alliances, so we are setting sector targets. And when we look at the portfolio, also we have these feelings that, wow, we are starting from this point, but how is the industry, the sector actually going? Where is the technology? Where are the data? So I think an important point would be really to not only to look at banks, but also to see a sort of a common effort in that direction. The second point I would like to make is about transition finance. So having said that, there is the public policy, industrial policy that is getting in line with us. What are we going to finance? What is transition finance? And I probably go back to the introduction that you made about what is a green loan. So we have seen a number of definitions. Taxonomy one. I told you we have been developing internal rules, but there is not, let's say, a common definition of what can be labeled as transition finance. So if you're looking at different banks, we have a number of targets. Everyone has sustainable finance targets, and we all use different, let's say, definitions of what is sustainable finance, what is a green loan, and so forth. So I think we still need to tackle this issue. We have seen, of course, the EFRAG standards, but now they are sector agnostic. So, of course, we will need to wait for the banking specific standards coming in June 2026. And everybody will be disclosing entity specific numbers, which will be different by definition because we do have different definitions. Taxonomy, of course, was was a contribution to the debate. But if you look at the numbers, they are extremely low numbers. So we have our GAR is 2.65%. This is due to the fact that the calculation of the GAR is somewhat strange for financial institutions. But having said that, it is in line. It is even pretty good compared to other peers. But is that the real effort my bank is putting in financing the transition? I would say no. This is not reflecting the overall effort. So we will see the number increasing because we will see more, let's say, more companies disclosing their numbers. We will be more, let's say, ready to use these technical screening criteria to apply the do not significant harm criteria that have been so difficult to integrate, and some of us have just decided not to publish any information on that. But let's say taxonomy has been so far a big effort, especially in terms of disclosure. We have published 70 templates, so big number of pages. Is that information useful or not? I don't want to say that, but of course it's a lot of information with, I don't know how useful in a sense. So it's clear that we do not only have to focus on what is already aligned, but all the path. So when we are supporting companies that are along this path and going to be aligned or that are transitioning, then that's the real finance for the transition. So there is also a matter of definition that I think is important also to be more representative also. And for example, for rating agencies also to be able to compare numbers one with the others rather than have all different definitions, very difficult to differentiate about the numbers they see. And there is an issue of data availability. We have been touching on that somewhat. We have seen increasing data coming from the companies. Of course, with the CSRD and with enlargement, we will see more data. On the environmental side, I think we are more mature on the climate side, much less on the environmental side. So I will expect that probably in the future you will have some seminars on natural capital and how to preserve biodiversity. We are starting, we have run some pilot exercises using the TNFD approach. We have been started to, let's say, to think about that, but it's even more difficult because at least with the climate, you have the metric about emissions or CO2 equivalent, while on nature is much more complex, kind of what metrics, how are they measured, and so forth. So that is another issue. And the last one, and I close with that, is on regulation. We are very busy in implementing the regulation. We are asking more, for example, now with the implementation of the CSRD, the one on the disclosure, we are asking more and more coherence between the different regulations. So, of course, for example, interoperability between reporting standards are very welcome, but we are still struggling with that, and also struggling with a number of reporting requirements under voluntary agreements such as the Net Zero Banking Alliance or PRB, or a number of international or SDGs, and a number of international sustainability commitments that require reporting documents that may differ. And so a lot of reporting, but maybe not so much focus on what is really important. So of course, regulation is important, but there is really a big call for coherence between the regulation that is coming. Another issue is about transition plans. Transition plan, we have started to publish transition plans with the along with the net zero effort, and that was a transition plan for the net zero actually. That was in deadline, and how are you going to, we set the targets and we say, okay, we are going to go along these lines, and we want to go and reach these targets. Now with the CSRD, we have also transition plans to publish, but probably the sense of the CSRD is not only net zero, but more general about transitioning. We have also the CSDD directive, the due diligence directive that is coming, that is requiring again to publish transition plans. So we see a lot of work on transition plans, evolving from one concept and getting larger and larger, to and really be able to include all these transition plan, transition finance, and transition actions. But it's a work in progress, and of course trying to concentrate efforts in that respect would be a lot useful for, especially for preparers, but I think also for the people that are looking at the information that we publish and we provide.
Thank you, Elena. Also, thank you for touching on two things that have not come to the fore during this day and a half. That is the issue of nature and the issue of transition plans. So on nature, there is a lot of work going on. That you mentioned the work by the TNFD. There is work by the NGFS that has been trying to forge ahead, has issued a publication on a conceptual framework. Clearly, when you go beyond, try to go beyond the conceptual framework, you bump into a whole bunch of problems, beginning with data. You don't even begin to know where to collect data on this front. And the Bank of Italy within the NGFS has been pushing forward, and I know that Fabio is also involved, the IMF is also involved in this, are also pushing toward the idea to try and piggyback on the climate part, and therefore trying to explore the synergies, the cooperation between, for instance, water and CO2 and climate, etc. But it is clearly an important issue that needs to be on the map, and should not reduce the effort on what has been done so far. And on transition plans, let me mention that I think the most important part for the European regulation is that these transition plans are going to be required of non-financial corporations. That is a key issue, because it is all easy and simple to say, okay, I commit to net zero for my finance emission between now and 2050, when another CEO is going to be leading the bank. But the key issue is that finance emission cannot go down unless the non-financial corporations mend their ways. And transition plans are not going to be just pledges; they should be investment plans, basically, numbers with investment figures that would allow intermediaries also to assess the validity of an industrial project, of an industrial investment. So these are really crucial points on which the debate recently has been taken off, and is probably going to be very fruitful. But let me go back to Fabio, who raised the issue of emerging markets and the issue of how to scale up private finance for those markets. What do you think, Fabio, could be the policy measures that could help address the barriers that, for instance, advanced economies money has in accessing those markets? What can be done vis-a-vis the B- problem raised by Pierre, and what the role of the IMF could be on this front?
Start maybe for one point that Pierre made, I think it's important, right? So there's different buckets. We can think of barriers for emerging markets. The NGFS produced a blended finance paper that was essentially looking exactly at this. But I would start with the EM specific barriers, right? There are barriers that EM face to access finance. They have nothing to do with climate. They've been there for decades, and they will be there with or without climate, right? So some of them are structural, are policy uncertainty, the institutional framework, the legal framework, and all of this fits into their ratings in the end, beyond climate. I think Karia here has done work on this. Just a fact, like the share of emerging markets, they are investment grade, it's around 50% or so, right? Those are have investment grade, no matter what you do with climate. And you're not gonna fix that just because you work on climate in some sense. But those are structural issues, they are there. And they were there before climate. There are also conjunctural component to that, which just coming out of COVID with rising debt levels, fiscal outlook deteriorating in advanced economies, but it's true also for emerging markets. And interest rates are higher. They tend to follow more US rates than European rates. So the level step, it's even more significant. So everything else equal, that means the cost of capital in emerging markets is, if I use the fair fund rate as a floor, it's 5 percentage points higher, period. And so at this point, for some investor, when you start making those calculations, do I get 8% in US high yield, even if I want to go into a yield, or do I go into emerging market and face all this like long list of issues I need to face? That 8% is much more attractive than it was when interest rates were close to zero. So that part, whether US rates will come down a little, whatever the Fed dot plot does, but the level of rates is high now. And so those are issues that have nothing to do with climate, but they become an additional challenge to tackle climate and bring private capital in. The second one, I think barriers to do again, even before you go into private finance, it's like having climate policies in place, right? So again, the keynote yesterday, we spent quite a bit of time talking about carbon pricing. I think there has to be carbon pricing, whether this is directly carbon pricing, shadow forms of carbon pricing. What needs to change is the relative price of brown to green. You can do in different forms. Some of them are more efficient than others, but that's a prerequisite, I think, to bring private capital in. The next point, and I think that's where the ISSB effort is quite important, is like what we call the climate information architecture. So you need data. I think you always start with data. I think Pierre mentioned it, Elena mentioned it too. You need high quality, consistent, comparable data. And if you think you have challenge with data in advanced economies, good luck when you go to emerging markets, right? Think about scope 3. Like you ask companies to disclose scope 3 in emerging markets. So imagine when you go there. Of course, you can think of data as a public good, but we are all in favor of thinking of data as a public good, but there are private entities that collect data and commercial data. So I'm not sure how to think of that. Ideally, yes, should be a public good. How do you get there? The GFAN's effort with the net zero data public utility, they have this concept of public utility and they provide data for a few hundreds companies, but it's a number of agreements with private providers. How much more you can go ahead there? I'm not sure. Ideally, yes. That's where I think technology can help, like AI can be helpful here in making data collection more efficient and less costly. So by all means, let's use technology. The second piece of this climate information architecture, I think, is the Europeans like the word taxonomies. Across the Atlantic, classification is much more popular term than taxonomies. There is allergies to the word taxonomy, so I'm just gonna use classification, given that it's to be safe. But the issue is whatever you want to call it. I think I'll speak for myself. I think the likelihood that the European taxonomy will be adopted globally, it's not particularly high. And so what is crucial here, particularly given the time frame that we need to act, is interoperability, right? So that they can speak to each other, so that you don't have to face, if you are a large company, disclosing like through different format and different requirements, it becomes very hard. We've done some work with the World Bank, the OECD, and BIS to come up with some principle to think about different alignments, different disclosures, different classification across jurisdiction, and how to make it more interoperable. And I think, to me, in the interest of efficiency, given the short time frame that we have, that should be something that I think is much more can be more impactful at this point, just to think about interoperability of this classification. Then there is the disclosure. I think the ISB can play a really crucial role here with the disclosure. They've been, Paolo mentioned the number of years it took for other disclosure. This has been super fast. And I think, of course, the flip side of the fast now, there are a number of operational issues that the ISSB is going through, how to operationalize this. I think what would be helpful is the digitalization, for example, of disclosure, so that can help in terms of speed, the cost. There is an issue of the implementation, and I'm not going to spend too much time, but I think one risk for emerging market is that they will be, given the challenges they're facing out, that there's a risk they can be left behind for a while. That might have an impact in terms of capital, because if you perceive their lack of disclosure or the longer time to disclose compared to advanced economies, I'm concerned that there could be, at least in the short term, a negative impact in terms of flow. So that's something for maybe Emmanuel to keep in mind. I know that there are some emerging markets also that are pushing on that, but make sure that they are not left behind, because again, that's where you need a lot of private capital. Then there is the issue of the demand for capital, right? So often the issue is not necessarily that there is no private capital, there are no projects to fund. There are no fundable projects. That's where I think the IMF has no role. We don't do project finance, but the MDBs and all the World Bank, International Development Bank, they can play a big role there in helping with capacity development, technical assistance, project preparation facility to actually help enough projects that can be financed. In some cases, there is money, there are no projects that can be brought to market. The next issue is the issue of supply of capital. One is what is the role of the private sector? And I think I'm not going to spend more time on that. But to Pierre's point, there's only so much you can do with debt. In some cases, you need equities. And bringing private capital equity into these countries is really challenging. But there is a need more for equity. You cannot fund some of this project with just debt. You need equity, and equity cannot be just public money. You need private equity. There is an issue of what is the level of concessionality. I think there, of course, the long list of people coming to the fund discussing this issue with us. The first question you always get, like, we need more concessionality. By all means, everyone needs more public money, de-risking you. But I think there are also entities and private sector firms that actually operate across the life cycle of this project that they are not using public money. They are actually good at what they do at that specific point. Their issue is bringing this to market, for example, right? So it's not just how much public money is needed to the risk, it's also where it needs to be used more efficiently, where is the biggest impact. And I think that needs more work that needs to be done there. There is an issue also, obviously, of the reform of the NDBs. I'm not going to dare to go into that issue. Every time the fund touch that issue, I get burned, so I'm going to stay away. But there is a big debate of how much risk the MDBs can take, how to use the balance sheet more efficiently. And the bank is having a lot of interaction with the private sector, and we're working with them in the realm of the RST, right? The facility I mentioned before. A lot of this is like having roundtable with private sector and all the public sector involved. So that's been, I think, a big success. And then the issue from a just private sector, I think, is again how to aggregate this stuff, right? There's a number of risks there. One is the effects, right? So if you think about if you want to aggregate across regions, you're going to have a bunch of currencies. How do you deal with effects risk, for example? How much can you diversify away? Do you want to aggregate across countries, right? So that you can have the risk can be diversified. How much project level can be diversified? So if you think using like a structured finance vehicle, is how much equity do you need? How much has to be public versus private? How do you bring these, put in place essentially those structures so that you can generate investment grade fixed income that can attract the biggest institutional investor? That's much easier said than done though. Because what are the attachment point for equities versus debt? Do you need junior debt? Who provides that? So it gets very complicated just at the portfolio design. Two more things and then I'll stop. One is, the last one is the role of the financial intermediaries. Now I'm going to poke it here for a second. I think there is a need for more transparency there, particularly methodologies. Often the confusion is people just don't understand what methodology are being used, how to compare one rating agencies versus the other. The more transparency, I think, the more we help. The second point that there are, I call it financial intermediary, information intermediary, if you want. There's a huge ecosystem there, and some of these players are new, some of them are data providers, some of them are product providers, some are advisory. there is a sense sometimes that there is some conflict of interest there when you start providing too many products across too many different lines. I'm not looking at one specific firm. It's a general point, but if you provide indices, if you sell data, and if you provide advisory, at some point, I think the supervisor, regulator, whoever is in charge of those, I'm looking at Paolo, there's something to consider there. Because you need to build trust in the market, right? So that's one way, I think, to build trust in the data and the products that are out there to address this. And then this is a very complicated ecosystem, right? It's not just the private sector, it's the public sector, it's the financial information intermediary. The concern is that there is a lot of fragmentation. We had a chart in one of the papers showing just how many public entities provide public concessional capital. And even using the full one page of that paper, you need a binocular just to see the names. There are more than 80 plus climate funds in the world, just climate funds. So how to do that? And then this perception gap. Often it looks like public and private sector don't speak to each other. The public sector thinks that they're doing enough, and it's just the private sector doesn't want to take risk. And the private sector thinks that the public sector is not providing any de-risking here, so why should I go there? That perception gap is very hard to close. And I think the model that we've used in these countries for the RST trust, of bringing people around the table and having them talk to each other on a specific issue, a specific country, I think that's been quite successful. Because at some point they need to translate in one language, and just having around the table has been great. And I would say use the technology. There is technology now to make data better quality, cheaper. By all means, let's use it.
Fabio, for over coffee, he promised that he would speak more slowly than usual. I was trying to jot down the list of items here,
I forgot that.
At some point I stopped because really you have here probably an agenda for 10 conferences. But
we can do it again every year.
Relevant point. Oh, that was my initial idea. So maybe we can. But so you, in the end, that I remember, you touch upon the data issue several times. So I think I would like to go back to Emmanuel on this issue of data that is at the beginning and in some sense at the end. Of course, the ISSB is fully involved in this. The Basel Committee is also involved in this. Over coffee, I was talking to Joanna, who's attended this conference over the public consultation that has been conducted by the Basel Committee. So beyond what the ISSB is already doing, which is a lot, what are your thoughts, Emmanuel, on what the private sector could do about this? Banks, but not only banks, insurance sector, etc., and what central banks can also do in order to favor greater developments and harmonization of metrics, which are one piece of the puzzle.
Thank you, Paolo. And I will probably have to stop after this because I have a hard commitment, unfortunately, at 12:45.
But we are concluding.
Okay, thank you. Well, the first thing I would say is that to respond to Fabio's very legitimate challenge about emerging markets, indeed, for me, what I think really interesting in the current momentum is that there is a lot of appetite for our standards from the developing economies. I mentioned some, but again, Kenya, Nigeria, Bolivia, Costa Rica, Bangladesh, Sri Lanka are on the list, the official list of countries that have declared a commitment to adopt the standards in a journey that will probably be a few years' time, starting from now. And the reasons for that is, for me, very revealing. I'll just share one, which is that we were in a visit with the Nigerian government about 2 months ago, and discussions, including with the President of the Republic of Nigeria, included the fact that Nigeria was concerned about the $500 million of cocoa exports to Europe, with the European anti-deforestation regulation being in place at the end of this year, and the fear that they could be fined or banned from those exports. with a lot of smallholder farmers being involved in that. So social transition again. And the conversation was about the fact that the large cocoa companies, which I happen to know pretty well, and the chocolate companies in Europe, they cannot not have Nigeria's supply. But because they will need to invest money and build capacity in the supply chains to change to regenerative agriculture models on cocoa, but on coffee and on many others as well. And they will choose the jurisdictions and the supply chain where they find most transparency, most accountability, better data that can then lead them to measure their return on investment, basically. So the idea was very simply that as much as the transparency that our standards would bring for a private actor value chain, the same works for countries. And it's really interesting as well that, as I mentioned earlier, that the IPSASB is now looking at using IFRS S1 and S2 as the base for the sustainability standards as well. And finally, Paolo, you mentioned the Basel Committee. I do believe indeed that there is a systemic role here that between banking supervision, private sector and public sector accounting, that gradually we put in place a global language that will help surfacing those topics and make sure that those topics, starting with climate and the just transition that needs to happen with that, the physical risks on water, etc., are surfaced in macro and microeconomic conversation that will lead to reassessing risks and return. I'll just finish by saying one point of recent encouragement for me in Frankfurt actually was that a couple of years ago, I remember a discussion with central bankers, including at the ECB, about the recognition that some of the inflation that we see is related to climate, physical risks. And now the fact that in a number of central bankers debriefing of their regular meetings, the climate risk is portrayed as an upside on inflation outcomes, I think is a very encouraging sign that what was below the surface, as I just mentioned about the Rhine River, but the energy transition in Europe and everything else, it starts to become part of the official language of central bankers, and I think it's critical that this continues to be the case.
Emmanuel, thanks a lot. I know that you need to leave, so I would take a moment here to give a big round of applause to our panelists. But we have compressed the time for Q&As, and unfortunately, Emmanuel had to leave, but we still have about 10 minutes to for Q&As. So in case some of you wish to raise issues, I wouldn't doubt it. So, Katia.
Did Manuel leave already? I actually wanted to react to some of his.
I think he has, because
okay.
he mentioned that in advance.
But I would like to add to Fabio's list, which was not exhaustive, and it's especially in.
Should have gone faster then.
In relation to Manuel's comment that capital market and actually public asset classes is probably has much more potential to redirect the flows for energy transition or for transition, for sustainability transition. And I think this is another dimension of what Fabio and I had been looking at with regards to emerging markets, is when you look at the financial sector development for emerging markets, and it includes both banking system and capital markets within those countries, both public and private capital markets, they are significantly underdeveloped or even non-existent. In fact, IMF has on its website index of level of development that incorporates a number of different criteria for developing markets, and you will see the ones that need the capital the most are the ones that actually have least access, even through their systems, both banking and market. One other perspective I wanted to add on capital allocators and how that system evolved of developed economies, asset owners, and especially universal asset owners. And I started my career as an asset allocator when emerging markets were expected to converge and grow, and there was the expectation, forward-looking expectation, that they would be converging closer and generating higher returns. And as a result, capital allocation was considered emerging market as an asset class. What we have discovered in our conversations with Faber, with capital allocators now, the narrative has shifted. The emerging markets are no longer this promising asset class that will outperform the other asset classes, as was the expectation 2 decades ago. And we see significant retrenchment in capital allocation teams, institutions away from emerging markets. We have seen it that even significant movement away from even considering emerging markets in the largest public sector pension funds, universal asset owners. And I think with the war in Ukraine in particular, those that apply capitals have become even more aware of reputational risk that overemphasized all the other risks that before were considered. And that had a significant seismic effect in institutions that supply capital and how they consider how they deploy it.
Thank you, Katia. I guess there was not a question though, so let's move to Antonio, please.
Thank you. I have a comment and maybe a question for Pierre. Going back to one of your earlier initial remarks, which is related to the very title of the conference. You said that the S and G components of ESG may not matter or do not matter at all for credit risk, unlike climate risk. I agree with that, and thinking that what the ESG score is, it hides at least 100 different variables, at least in the definition that one of the providers we employ adopts. So clearly not all of them matter for credit risk. Still, let me suggest one reason why the S and G letters might matter, namely because they are instruments or proxy variables for things that may matter and that are not otherwise observable, like legal risk and managerial capacity. So maybe, and so this is one reason to continue investigating the possible materiality of some of the S indicators as well as some of the G indicators for credit risk. Maybe you can comment on this.
But I thought George was saying that the G is very important. But maybe we can collect a couple of questions and then maybe we let the panelists react all together. Thanks a lot.
Thank you very much for the very insightful panel discussion. Actually, I like very much the concept that Pierre mentioned about the need of reality check. But we have learned these 2 days that climate indicators sometimes are far from reality. Yesterday we mentioned carbon emission data. Elena mentioned NPR. It's not representative of the effort that banks are doing. So what would be, in case of banks' disclosures, banks' transparency, the reality check? Which indicators should the reality check based on to give a flavor of the efforts that banks are making to disclose their strategies?
Let's get, so I saw two hands, quick, please, colleagues, be quick. Two hands, and then we'll give the floor to the panel.
Thank you. I have a question on the environmental part, so the part on nature that we didn't explore that much in this conference. And here I would like to ask to actually all whether you are also considering nature risks also when, I don't know, for example, deciding the projects to fund, for example, for adaptation and so on, because the climate and nature, they are clearly intertwined, and they exacerbate one another. And especially there are some climate actions that could have a negative impact on nature. So we may just kick the problem out of the door, and it comes back through the window, like in 2 years' time or 3 years' time. So shouldn't nature be a high priority and going hand in hand with climate? And I know it's tough for nature.
Thank you. One last question by Fabrizio Prieni.
Thank you. And very quick, one is for Elena, and you talk a lot about the investment that was in Intesa Sanpaolo in terms of training, in terms of IT, and you already answered to Paolo's question on if you want the customer perspective. So if there was some benefit in terms of yields, the question is from the bank perspective. So do you have any, let's say, ex post evidence, back testing evidence that these investments were able to improve your ability to discriminate borrowers? And one very graphic, at the beginning you talk a lot about sustainability fatigue, and I would like to ask more generally if there is also sustainability fragility. Let's think to the European energy crisis and for instance to the energy trilemma. So in that case there was the security component that was definitely predominant compared to sustainability or to affordability. So in the end, we have some retrenchment to green investment, and we restart also with the use of some fossils. So how is fragile let's say the transition to very big external shocks?
Thank you. Let's go to the panelists, Pierre, for answering the question, and more broadly for any final considerations you may have.
Okay, yes, thank you. So indeed, yeah, sorry if I wasn't clear, but indeed, G is a key driver of rating action. So it's one which is core to our methodology. It's actually one that can move the ratings by several notches. So yeah, clearly, just to be clear, I mean, that's the G part is very, very important. But what I said is that it's already well understood in many ways. I mean, it's not an evolving risk. It's something which has been there, on which we have a clear understanding of the drivers, and which is already well embedded, I would say. On the S side, rapidly, I think my comment was more to say, yes, exposure exists. I mean, it could be, I mean, I was mentioning about labor condition earlier, which for some sectors like textile, like mining, is well known, well considered, but without any credit impact. Just because of, I mean, there's no penalty. Sometimes it happens. I mean, we had a case in the US where they were employing children. The fine itself, so it was, I mean, they were working in slaughterhouse. They were 13, 14 years old. And there was suddenly, I mean, they've done that because of labor shortage. That led to media attention, and they had a fine. The fine for that was $1.5 million. So nothing. So it was really material. The materiality came afterwards when all of the customers said, we can't work with you anymore. And suddenly, yeah, that changed the story. But to say that it's, I mean, I'm sure we can find hundreds, thousands of cases like that. And sometimes one of them, yeah, come into attention and changes the story. But overall, we've not seen that significantly. Affordability could be another topic. So it's not things that we don't surveil, it's things that haven't moved the ratings too much. But affordability could be one. I mean, we see that with energy prices. Suddenly the states may ask the utilities or energy companies to, I mean, clearly have lower profits or higher taxes to compensate one way or the other the consumers. So that's another form of risk. So yeah, that's important. But at the broad picture, the number of rating actions we've taken linked to S are really limited. The question of banks, unfortunately, I'm not sure I'm the best person to answer because I'm not a bank analyst, I'm a corporate analyst. So I may defer to Elena, who may have a view on that. Sorry to put you on the spot, Elena. Yeah, and maybe if I can say, I mean, just a final word and concluding word, it's I would say that first, two words. Nature. Nature is important, but we shouldn't fall into the same pitfall as ESG. Nature is very broad, and we need to be spot on exactly what we mean. So to me, the key risks are maybe water today and pollution, plastic pollution in particular, which would be the two emerging risks that I see when it comes to nature and credit implication. And last but not least, I think my concluding word would be that a lot has been done. I mean, that was my starting point. I mean, we worked a lot. There was a lot of investments. There's a sense of urgency that Fabio really stressed when it comes to climate risk in particular, and we want immediate results from those investments. And the reality is that those immediate results will not come. So we need to cope with that. I think there's a lot which has been done, and we are getting more and more prepared. But yeah, let's be patient as well. So we need to cope with urgency. We need to cope with the patience of everything that has been done.
Thanks a lot, Elena.
Thank you. Well, on the question about do we also see effects on measures such as the PD, I expect. Well, for example, we ran an analysis together with the Bocconi University linked to our circular economy plafond, and which is publicly available, so you can look for that. It's on the de-risking effect coming from these. So actually, we saw a correlation between, let's say, loans that were granted according to the criteria that we established for that particular plafond, and also having an effect with lower PD with that portfolio. So we begin to see some evidence, even though usually you need longer time horizons in order to make all the regression exercise. So let's say that we still have to work on that. We are seeing some evidence on some specific portfolios, but not, I would say, we are still working on more general evidence and also waiting to have longer, let's say, time series to be able to support the thesis. On the reality check on ESG ratings, on banks looking at ESG assessments for a long time, usually the correlation is extremely low, not only for banks, but for sure for banks. So if you see the list of the components of the Dow Jones or the CDP, where CDP is on climate, but Refinitiv or Sustainalytics, they do have different list of components. Correlation, I think it's 0.5 around that region, so rather low. This is due to the fact that I'm looking at different metrics, different weightings, different analysis. Some apply a controversy filter, others would weight this less. Even making a comparison between these methodologies is difficult to make because sometimes the same issue would be in the G component, while in other models would be in the S. So not easy for that. We always include one slide within our results that we present to the investors with a comparison in these different ESG rating agencies to let's say to show that we rank very well. From how you look at the bank, it seems well positioned. So in the sense that the commitment we have been taking, the sustainability area is rather complete. So would cover all these different measures, but reality check is difficult to make. We will see more, let's say, standardized reporting now with the CSRD, but we will have to wait for the standard specific in order to see that. Maybe from that, at least it would be more comparable in a sense, looking at the same metrics.
Thank you, Elena. The floor to Fabio for some maybe final remarks in addition to possible answers to the questions.
On nature, I completely agree. I think the challenge is the following. I think it feels a little bit like we were with climate a while ago. And so I think there is really a need to have a framework that links this to financial risk, to financial institution. Otherwise, the buy-in is going to be very challenging. That doesn't mean that individually people don't agree with the objective, obviously, having a better planet, a livable planet. But seeing the challenges there was with climate to make this more into the mainstream from a central bank perspective in terms of financial risk and stress testing, that framework and that link with financial risk and quantifying, I think is necessary. Otherwise, that ESG fatigue, political backlash, it's just going to be counterproductive at some point. There are also other challenges, right? Paolo mentioned one, which is data. I think if we think we have a problem with data when we talk about physical risk, the challenges are multidimensional there. And there are also, I think, conceptual differences too. Some of this is more localized, for example, right? So emissions is a much more easily seen and visualized, easy to visualize concept, right? There are emissions up there, they stay up there for hundreds of years and they cover it in the full globe. Some of the nature-related issues much more local and localized. And so how to think about this issue, I think there is, personally, I think there is more need. If you rush into this without establishing that link to the financial risk, as it was done for climate, may become actually counterproductive. I'm not minimizing the issue, I'm just having lived some of it on the climate side. I'm just trying to bring my, at least personal experience on this in the institution I work. We are doing some work on nature. For example, during the spring annual meetings, we had a joint workshop with the Dutch Central Bank exactly on this. Right? It was organized by Monetary Capital Markets, where I work, and the Dutch Central Bank. They presented a paper that they put out a few months ago. That was actually very interesting. But that's what we need, I think, to sell the concept. Otherwise, we're just gonna, if you think there's resistance against using the word climate, the resistance is gonna be even greater. Yeah, so in fact, for example, at least in the US, one thing that people are starting to realize that if you call it climate adaptation, you get straight into the political minefield. If you call it resilience, that's a much more acceptable and politically acceptable word, right? So people start dropping using the word climate adaptation, but resilience, you can't be against resilience. And so, but climate, nature would make this issue like to exponentially more difficult. Maybe a couple of things before we close. I think one, I want to start thanking people. I would start with thanking obviously all those that worked for making this conference possible, both the organizing committee, the Banca d'Italia. I think the funders then less there. But there was obviously a program committee. Monica was part of it, Katia and Valentina. Then there was Professor Bolton and Professor Giglio participated, and they went through the paper. So if we have good paper and a good discussion, I think we need to thank them. I would also particularly like to thank the Venice location and everyone who has made this possible. I just really like to come back to Venice. So, but I haven't been into the building. I haven't been here in this building. Of course, Annual, this one is a done deal. I'm just looking straight here. But I haven't been into this building. It's a gorgeous place to be. I feel a little depressed going back to my little IMF office after this. Maybe a couple of things. I think what at least personally, I think I learned, and then a list of possible topics for the next 5-6 conferences. I think there was good work on the ESG and creditworthiness. I think there was nice paper that showed this with the challenge that comes with it, but it was actually quite helpful. Even the point, obviously, not to get too attached to the catchy ESG, but start dipping into them more. And I would add to that, for example, if you go into impact, that gets even more complicated. I think the bank behavior, the papers today, for example, they were quite helpful. I think financial institution can be more aligned with the NDCs, for example, and the work that is being done through the ISSB as well as the various regulatory work. I think that can be helpful, but you can't stop with financial institution. Paolo said there has to be something at the corporate level. Otherwise, we go in circles. Another point that was helpful is the work on, most of it was on corporates. There was something on mortgages. I think we need to do more on mortgages, particularly if you want to create like green mortgages markets. That's a need for standardization. There's work in Europe. I know that because I've been involved to it. If you go to the US and you say green mortgages, they look at you like, who are you? So there's a lot of work that needs to be done there. A lot of the emissions come from buildings, right? And North American buildings are not famous for their energy efficiency. Starting in my own house where I live. It's a daily fight with my son with the AC up, AC down, AC up, AC down. So, but there's no market, there's no concept of that kind of mortgages. And I think that particularly given the market structure of housing in the US, if there is the political will, the Fannie Freddie system could be one way to do it. But I think more work needs to be done. Another topic I think is the importance of data. I'm not going to spend more time here, but I think there's a lot of progress on the physical risk, right? You can use technology, spatial, and there was a paper on the flooding in the Emilia-Romagna that was actually really nice. And so I think that using technology to improve data quality and availability, that can be an accelerant of all this. One last couple of points. I think there was the disclosure point. I'm not going to spend time here. I think there are a lot of challenges. My personal view is that we are underestimating the challenges for emerging markets. We went so fast with the disclosure, and now we're starting to realize that yes, there is demand for standard. They want standard. The challenge is how to provide the data. And I keep repeating every time I see Emmanuel. It's the operationalization part. You went fast on launching it. Now you need to make it work. And then finally, the last point on the stress testing. I think there's a lot of advance in stress testing. As I said yesterday, the fund has a different horizon. We do 3 to 5 years. But even at the longer horizon, I think the more you make this model granular and you start bringing in investment, how to think about investment, I think that's going to bring you from the back door the role of policy. Even if you take a longer horizon, you need to think about monetary policy and fiscal policy. Right? Fiscal policy in terms of subsidies, for example, for green investment, or monetary policy, because as has been mentioned more than once, some of this stuff is inflationary, and central banks will respond. And that's going to impact feedback into how the investment process works. So the more we get granular with the model, the more this is a need to think about fiscal and monetary policy, I think. That was my quick summary, not that quick. I think in terms of topic to think about for the next 5 years, so we can get to 2030, and assess by 2030. I think one is that we are late. We are really late with this. And so the cost is going to rise, and adaptation and transition will start feeding back in a negative feedback there. And it boils down to political economy. Unfortunately, economies are not, some economies are really good at political economy, but others less so. And I think the discussion here of political economy was not the discussion, but it is a huge political economy. Like if you look at the US, it's quite obvious that you can go backward very quickly. There is, I think, an issue of how much of this we're putting on finance, right? I think there is a need for carbon pricing, because if you don't do that, finance is going to become an issue for Paolo and central bankers and regulators. And finance there's only so much that finance by itself can do, as central banks can do. But you need the fiscal side to do its job. Otherwise, everyone else, both the private sector and central bank, will be a proxy for fiscal policy, which won't take you there. There's an issue EM. I'm not going to go into the EMs again. I mentioned before, but I think some of these conferences, there's a need to bring also the emerging markets, including like inviting people that have done work on emerging markets, because they bring a really, really different perspective when you talk to them. It looks like you're on a different planet. I think another issue that would be important to think about, again, is this adaptation transition feedback. One topic hasn't been mentioned. I think Paolo asked the question, but we've been very focused on banks. Some of this, it's about NBFIs, right? Think about the private equity business in the US. How much is like green versus brown there? I've seen some work where they're starting to have green PEs versus non-green PE, but then they don't disclose. So I don't know how much of this is like repackaging. But a lot of the financing, at least in the Anglo-Saxon world, is done by non-banks. And we have done very little work on trying to understand. That could be a conference just on its own. And then finally, a couple more. The data, I think you could do just a conference on data and technology. There's, I think, a lot of thinking that needs to be done there can be done. And then finally, as a counterpart of this, yes, technology helps. Yes, can help in a long way. But we are in a city that has been facing climate for 1,000 years. I don't know. I'll look at people from Venice. And I think there's also to learn how they address the climate stuff, right? So technology can help, but this city has been up for hundreds and hundreds of years. So we can learn also how things were done back then without jumping just into the technology.
Thank you, Fabio, for the quick roundup. Elena's leaving, so again,